Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, welcome to the podcast. Today we've got a really great episode about US-UK cross-border tax planning. And I'm wearing my special vest, or as they say in the UK, gilet, because of today's guest, Alexandra Britton-Davis. She goes by Alex. Alex is from Saffery, which is a Nexia firm. It's a part of our network. And anytime I go to a tax conference, they're always decked out in their gilets. So I thought I had to put this on today so that I could fit in and be one of the cool kids. Alex, why don't you tell our audience a little bit about yourself, your education background, kind of so they can get to know who you are.
Cool. So I'm Alex. I'm a tax partner at Saffery here in the UK. I'm also a chartered accountant and chartered tax advisor to practice in the UK. And what I do mostly is private client tax advice, but for UK individuals who have some sort of international aspect. So whether that's US individuals moving to the UK individuals going abroad, or anyone who might have some sort of international issue that involves the UK.
Great, fantastic. So for those that listen to the podcast, a couple months back, I did a podcast with Maseko, with Andrea Solana, and we talked a little bit about the proposed changes that were going to come through in the United Kingdom, which happened on October 30th. Alex is here today to give us, as we say in the US, the inside baseball. Now that we know what's being proposed and what's going on, she's going to talk us through about, how did we get here? What does this mean? We've kind of divided up the podcast into three different segments. And I don't want to spend a whole lot of time giving a bunch of background because I know Alex will do it for us. So let's get right into it. Alex, why don't you tell us about the October 30th announcement and some of the background about how we got here, and then we can get into, that first big topic.
For a long time in the UK, we've had this basis of taxation, which we call the remittance basis. So what that means is people who move to the UK who are what we call non-doms, so those not domiciled in the UK, they can get this special basis of taxation where they only pay tax on their UK income and gains, and then their foreign income and gains, but only when they bring it to the UK. So essentially, they can pay tax only in the UK on UK assets, but all their foreign income and gains can remain free from UK tax. And that's been in place for a really, really long time. And at the moment, individuals can use that basis of taxation for 15 years. And once they've been here 15 years, then they have to switch to the worldwide basis.
And there's a midway point though where you have to pay. I call it a ransom. We kind of make fun of it here in the U.S. There's like a little ransom charge that you have to pay to get to the 15th year, right? About halfway through.
Yeah, that's right. So after 7 years to carry on using this basis, you have to pay £30,000, and then after 12 years, that goes up to £60,000. So this is something that's really, really useful if you've got quite significant foreign income and gains. So for some people, £30,000 will sound like quite a lot. For others, they'll be thinking it's an absolute bargain, happy to pay it.
Yeah, well, I mean, if we think about Italy, for example, I think that they require, a 200,000 euros. So, I think relatively speaking, that's a heck of a deal. Okay, so let's go into some basics in the UK. So UK tax compliance, my understanding, pretty easy to do. You guys are in a fiscal year, April 6th to April 5th, something like that. Is that correct?
Yeah, so other than our slightly strange tax year, which is always at odds with every other country around the world, the tax return's fairly straightforward, particularly for those individuals who are on the remittance basis, because they can just tick a box, claim the remittance basis, and then they only have to put their UK source income and gains on the return. So at the moment, a very straightforward filing position for people.
Okay, fantastic. All right, let's go into some of the changes, because when I was at a conference in Singapore and I heard some of your colleagues, Stephen and Claire, who did a fantastic job, they were talking about these changes. And what was going on in my head was the UK is trying to be like the US. You're trying to make everything super complicated and you're trying to make your compliance difficult. You're really reaching for the stars there when it comes to some of this stuff. Talk me through let's focus on the non-dom tax changes, then we'll talk about inheritance, and then we'll talk about offshore trust. Let's just focus on non-dom though. What are the new rules? How are things changing? Talk to me about this new, what do they call it? FIG regime. That's a great acronym, by the way. I love acronyms. Talk to me about that and walk me through it.
Yeah, so as people will know, we elected a new Labour government back in the summer, and so the 30th of October was their first budget where they sort of announced quite sweeping changes. And some of those biggest changes were around this non-dom regime that we have. So they had said for quite some time they were going to abolish the non-dom regime, and that's exactly what they've done. So they are getting rid of the remittance basis of taxation, and they're replacing it with this, what they said would be a simpler regime. That's a 4-year regime, and it's called the FIG because it's foreign income and gains. Okay. And what that means is for 4 tax years, new arrivals in the UK can pay tax on just their UK source income. The foreign income and gains are tax-free. So what's really good about this regime is under the old remittance basis, that income and gains earned abroad was still taxable if you brought it to the UK. But under this new regime, it's not taxable. You can spend it in the UK, you can bring it here, and you'll just never have to pay tax on it. Now, what's obviously not so good is it's only 4 years. That's quite a reduction from 15 years that we have currently. So that's going to be a really, really significant change for people.
And there's no ransom, right? You don't have to pay the £30,000 or the £15,000. Everyone just kind of gets this transition rule for 4 years if you want it.
Yeah, exactly. So there's no fee to get this relief. There are some slight things, like you lose your personal allowance if you claim this relief. Okay. So that's currently 12,500. So there's a few knock-on impacts, but no fee like the Italian system or the current UK system, and it's just tax-free, full stop. So relatively simple.
Gotcha. And just to rewind back for a sec, personal allowance for our US listeners, that's kind of like the standard deduction in the US. It's everyone gets it, and it's just an amount deducted from gross income for tax purposes.
Exactly. Okay. And in fact, individuals who earn over £100,000 start to see that being reduced anyway. So a lot of people don't even have it. So I say it's not a ransom, it's a small point. Okay.
So let's now talk about how the UK does residency under this new regime. Talk to me about statutory residency test, how residency will be determined, all that stuff.
Yeah, so one of the key things to sort of point out is that you only get this 4-year regime if you've had at least 10 tax years of non-residence. So for completely new arrivals in the UK, they'll qualify for this regime. But for those individuals who have previously been UK resident, they'll have to have been non-resident for 10 full UK tax years. And we determine residence under what we call the statutory residence test. Okay. Now that's a test, it's a series of tests really, that look at your ties to the UK, whether you have a home here, whether you work here, and broadly, depending on how many ties you have, there's a set number of days you can spend in the UK without being UK resident. So it's a little similar to the US test in that you're counting days, but you have to look at lots of other things as well. So the good thing about it is it does give you a definite answer. For example, you can spend up to 90 days in the UK this tax year and you won't be resident. The sort of downside of it is it's not that straightforward. There's lots of things to consider and to check. But we do have it is a defined test. There's sort of no grey areas in terms of, but what if your family live here, whatever. There's particular tests that you look at, there's particular days you count, and that'll give you your answer if you're UK resident or not.
And is that really step one? Like if someone comes to you and says, hey, I'm coming inbound into the UK and I'm going to come on May 1st, are you then going to say, okay, well, let's step one, when are you going to be a resident under the statutory residency test, or is there something before that that needs to be considered?
Yeah, we would always say, I mean, we do this at the moment anyway, because we have this 15-year test already for the regime, but we always sit there and say, okay, have you spent time in the UK before? How much time? When? Let's establish if you've ever been resident before. Have you had those 10 full tax years of non-residence? And then we'll look at when you're planning to come. When will you trigger residence in the UK? If they're arriving on the 1st of May, it's likely they're going to be resident for that year because it starts in April. But if they arrive in, say, February, they might not be resident when they first arrive, even though they have moved here, you know, bought a house, etc. So yeah, it's always important to establish when do they trigger residence, and when were their previous periods of residence.
So it sounds like there's a little bit of an objective test with the day counting. There's a subjective test with some facts and circumstances that need to be analyzed. Is there something that needs to be submitted to the HMRC, or is it a self-certification? Do you guys document it in your file? What's the paperwork threshold that has to go to doing this analysis?
So we don't have any sort of obligation to sort of announce you've arrived in the UK when you become resident, but you would need to register to file a tax return. So you normally register to file a tax return after the first tax year you're UK resident. And it's a very, very simple form that you send to HMRC, and then they give you the taxpayer reference number, and then we can go ahead, prepare and file your tax return. If you're UK resident, you don't really need to say anything about your residence unless you want to claim what we call split year treatment. So that's the people who have arrived partway through the UK tax year, and they want to be only treated as resident for tax purposes for the part they were actually here, rather than the months beforehand.
Okay. And just so the audience knows, HMRC is the UK equivalent of the IRS. Did the name change when the king came in? Is it different? Is it a different name now?
Yeah, so it was previously Her Majesty's Revenue and Customs. It's now His Majesty's Revenue and Customs. But fortunately, the logo is HM Revenue and Customs, so they didn't have to do all the updates to their IT systems.
Okay, got it. All right, interesting. All right, let's move on. So talk to me further about some of the changes that are going on. I read about this temporary repatriation facility. Stephen was kind of going into some of the tax compliance things that have to do with offshore reporting. Walk me through what to expect if you're coming in under this new regime and some of the issues there.
One of the things that we were actually slightly disappointed to see when we got the sort of announcements on the 30th of October is that they're actually requiring people to do a lot of reporting to claim this relief for this 4-year FIG regime. Under the remittance basis, as I said, you tick a box, claim the remittance basis, you don't need to report your foreign income and gains. What they're saying now is that to claim relief under this regime, you have to claim it on each individual source of income and gains, and you have to quantify those. So that's a lot of reporting for something that's not taxable. Maybe for US taxpayers used to paying tax on a worldwide basis, it won't be quite such a surprise.
Yeah.
But what will be quite difficult is, as I said, we have a very strange tax year. Nowhere else in the world has that tax year, as far as I'm aware. Please do write in if you think we're wrong about that. But everywhere, most people are on a calendar year. Some countries, it's sort of 1st of July to 30th of June. And so actually reporting foreign income in the UK is quite tricky. You know, for example, US taxpayers get K1s, etc. Those give you the information based on the calendar year, not the UK tax year. So the reporting might be quite tricky for people, and probably a lot more work than they are currently experiencing under the remittance basis.
Yeah, it sounds like someone needs to develop a product that can convert calendar year to fiscal year. So I know that you're saying the UK has that weird year, and you talked about the 1st of July to June 30th. I think you're going into Australia, New Zealand, those places. But, you know, India's got a weird fiscal year. Like I think it's March something to, you know, it's got a weird kind of timeline there. So it sounds like at some point someone needs to solve for how to convert whether it's fiscal year to calendar year or vice versa. I think that would be an interesting AI computer problem to solve. Okay, back to you. Tell me more about the changes and what's going on and what to expect.
Yeah, so we had a couple of transitional arrangements announced. So one of those is that individuals who are sort of flipping from the remittance basis to being taxed on their worldwide income and gains, they'll be able to get rebasing for their overseas assets. Now that rebasing is only to the value at April 2017. So
Okay.
that's obviously 8 years ago. So you might have 8 years of capital gains still taxable, but will be quite useful, particularly for those individuals who have got assets overseas they've held for many years, maybe perhaps property or something like that that they've held for a long time. It would still be advantageous for people who have assets standing at significant capital gains to perhaps sell those before April to realise those capital gains and not pay tax on any of it. Because as I say, that rebasing is only to 2017. It might not be that helpful for some people.
So rebasing, just so that we can define that term and talk to me like I'm a 3-year-old. That's basically just getting a different basis. So right, so I bought it for $100,000 in 2005. It's now worth $500,000 in April 2017. I want to just move my starting point for if I sell the asset up to that number, so that if I sell it and I'm under this new regime, I have a different basis starting point. Is that roughly correct, or am I missing something?
Yeah, that's exactly it. So it's looking at the market value in April 2017 and using that as your purchase price for calculating the capital gain. So as I say, if you've held it for many years or it's sitting at a significant gain at April 2017, that could be really useful. For those individuals who are maybe trading their shares slightly more often than every 8 years, maybe it won't be quite so useful. But it's worth having a look at what those values were in 2017. Is it worth holding on to those assets to get that rebasing, or would you prefer to sell them now and have that gain protected by the remittance basis?
So it sounds like if I'm already in the UK and I've been a non-dom and now I'm going to go into this new kind of regime, rebasing is something that I should be looking into right now, potentially.
Yeah, absolutely. Looking at what you've got, looking at how you can put yourself in a better position next tax year. As I say, if you're on the remittance basis, you might have been saying, I don't really care what's happening with my overseas assets. I don't care, how they're being managed, what capital gains are being realized, because I'm not paying tax on it. Now you're going to pay tax on it. You're going to care, what gains are being realized, when, how often things are being sold. That's all going to matter more. So it's important to review this and see what your position will be next year.
Yeah, and so 2 questions out of that. You're only going to care about it after the 4-year window passes, because after the 4-year window passes, it's worldwide taxation. So you sell it, taxable in the UK. And then the second question, sorry to put 2 questions together simultaneously. Second question is, what's your capital gains tax rate under the new regime?
Yeah, so broadly, you'll only care once you're outside of that 4 years. Although, as I said, the reporting means you might care a little bit, because you might want to make your life easy by not giving yourself really difficult things to report. But yeah, in terms of capital gains tax, we did get an increase in our rates in the budget as well. Not quite as bad as some of the headlines were suggesting it might be. So the top rates increased to 24%, which was already the rate we had on residential property. So not a particularly high rate, considering rates worldwide, and certainly a lot lower than our top rate of income tax, which is 45%. So capital gains still not taxable at a very high rate, but slightly higher than 20%, which is what they were before.
Yeah, well, I mean, if you think about the U.S., our top rate's 20, but then we have the net investment income tax at 23.8, so it's roughly the equivalent. Real quick, to go back to the rebasing, do I need to file something to show my new basis? Do I need to remit something to HMRC, or is that just something you document internally, or?
So it would just be when you sell the asset that you would need to report that. So you would file it, you would put the 2017 figure on your tax return, and then you'd make a note that that was because of rebasing.
Okay, but it still sounds like, and I always tell my clients this, the farther you move on in time, the less likely you'll be able to take the Marty McFly time machine back and figure out what that number is. So I I think it's probably a good, I mean, if I were faced with this issue, I'd be like, let's get it done now. Let's document it. Let's have the information available and codified somewhere. And, that way, if it ever comes
Yeah,
up, it's.
absolutely. If you're looking at a listed, a portfolio of listed investments, you might still have your portfolio statements giving valuations from 2017. Now, will you still have those statements in 10 years' time? Maybe not. But certainly, if you're talking about something like property or unlisted companies or something like that, where you can't just go online and find out what that value is, that's going to be something that it's worth getting those valuations now so that you've got them when you need them.
Yeah, I wholeheartedly agree with that. Okay, and for the new tax compliance that you guys have with reporting the FIG, the foreign income and gains, are there penalties if you don't get it done correctly? Like, does it got to be like spot on 100% conforming? I know that there may be some guidance coming out about how to deal with the U.S. and other jurisdictions that aren't on your fiscal year, but like how accurate does the reporting have to be, and what happens if I don't do it correctly?
That is, if you don't claim the relief on a source of income or gains, you don't get the relief. So essentially, the penalty is tax on that income or gains.
Okay.
Whether there's further penalties on top of that really depends on sort of your behaviours. So if you've taken reasonable steps and tried your hardest to get your return correct, and you've employed professionals where that's appropriate, then normally there's not an additional penalty. If you don't try very hard, don't put it on your return, you just sort of miss it off because you couldn't be bothered, then there'll be penalties. And if you intentionally miss something off, those penalties will be even higher.
Okay. And in the US, we've got crazy foreign financial asset reporting rules with really draconian penalties. Although I read the other day that that we're going to have Elon Musk looking at our tax compliance and try to make it easier. So maybe something comes out of that. But in the UK, do you guys require foreign financial asset? Do you require foreign bank account reporting, foreign trust reporting?
No, we don't have anything like that. So broadly, you just have to report the income and capital gains that are taxable, or that you're relieving under the 4-year FIG regime. Obviously, you need to actually report what's taxable and make sure you've got it accurate. But broadly, it's relatively simple, and certainly, in my experience, simpler than the US system.
No, absolutely. Anything simpler than the US system. Okay, what other items do we need to consider for the income tax? Any other changes that we need to talk about?
Yes, so one of the other transitional reliefs that they've introduced is what they've called the temporary repatriation facility. Now, this is something that was announced by the previous government and the Labour government have continued with. And it's potentially a really, really good policy. So what they've said is, look, we've got all these non-doms who have been taxed on the remittance basis. They've had to keep their income and gains overseas to stop them paying tax on them. So what we're going to say is, look, we want you to bring this to the UK. We want you to spend it here, invest it here. So they've introduced this temporary facility. It's going to last for 3 years. And during that 3 years, you can designate your overseas income and gains and pay tax at a lower rate. So for 2 years, from April 25 to 27, that rate is 12%. And then going forwards for one further year, it's 15. So as I said, 12%, that's a lot lower than our top rate of income tax of 45, and quite a bit lower than even 24%, the rate of capital gains tax. So that's going to be really useful for people who have had to keep things overseas, or are having to pay tax now because they want to spend money in the UK. They can bring money in here, and 12% is quite a low rate. So that's a really good policy. And what they also said was, you don't actually have to bring the funds here during those 3 years. You just have to designate them, which means you don't have to sell assets. So let's say you earn income overseas, you then bought a US property with it. You don't have to sell that US property to benefit from this. Maybe you're not planning on selling it yet. Maybe you're going to sell it in 5 years' time. You could designate it, pay tax at 12%. And then when you do sell that property, you do bring the funds to the UK. At that point, you don't pay anything else.
Gotcha. That's interesting. And I'm wondering how that's going to play out in the US with our system of foreign tax credits, if that's going to be an allowable credit that you can kind of add to your war chest. I mean, sounds like it's a deemed tax. So it'll be interesting to see how that plays out. Do you think there'll be any changes to the US UK treaty? You think they'll do a new protocol to kind of update all the stuff, or you don't, too much paperwork, too much hassle?
Do I think they'll do it by April? Absolutely not. Maybe eventually. One thing that we do have in a lot of our treaties, and this includes the UK-US treaty, is a clause that basically applies to remittance basis users.
Yeah.
So it says, if you're not taxed on something because you don't remit it to the UK, you don't get the benefits of the treaty. So if the UK is not taxing it, the US can still tax it in full, and we have similar clauses in other treaties. Now, that rule is going to change because suddenly it doesn't matter whether you remit it to the UK or not. So we presume the other countries will apply that on the same basis. Look, if you're taxed in the UK on the FIG regime, you're not paying tax on any of this US source income, the US is still going to want to tax it for the first 4 years. And thereafter, they'll start giving you treaty relief again.
Right. Interesting. It's such an interesting kind of, we'll see how that goes. I'm sure that on the US side, sometimes we run into issues like that and there's no real solution under the treaty. And then we have to do what's called mutual agreement procedure, or MAP requests.
Yeah.
So we get the two sides kind of together to kind of figure it out and see if relief can be given. And so I believe that we may see a lot more of that between the US and the UK in the future. Okay, anything else we need to think about for the non-dom income tax? Any other topics that you wanted to run through?
No, I don't think so. I just think the key thing is if someone is either already in the UK and they're going to be switching to the worldwide basis, or perhaps they're thinking of moving to the UK and wanting to use this 4-year FIG regime, the key is to sort of plan in advance, come talk to us. Let us know what it is you've got outside the UK so we can work out how that's going to be taxed and make a decision before it's taxable, because it's always better to know in advance.
No, absolutely. And, I told this to a client yesterday who was telling me, they were saying, we're thinking about being in France and in Spain and, the high net worth individual, high income. And we were talking about Italy, and I was like, have you thought about the UK? Now I'm pushing the UK angle now, because I'm like, there's a 4-year window there. It's pretty sweet deal. And, my viewpoint is that a lot of Europe is on fire when it comes to taxes, because you get Germany's in the midst of some change. France looks to be headed that way in the next 2 years. Spain's always got weird kind of things happening there with their wealth tax, solidarity taxes. And you get the UK, you guys are doing your big changes, and Portugal kind of just closed down the golden visa. So it's a lot of different things that are happening throughout Europe that make it a very interesting time. And I think this 4-year window is a fantastic option for a lot of people, as you just kind of summarized there. Okay, next topic. So in the US, we have an estate tax. So I'm a US citizen. If I die, I may be subject to the US estate tax. Now, what's really interesting is the new Senate Majority Leader of the US, John Thune, he actually put into a proposal for in 2022 or 2023, it's called the Death Tax Repeal Act. So he wants to get rid of the estate tax. And so, in the US, we're essentially having a new US tax code coming about. It'll be interesting to see if we do away with that. But in the UK, you guys have an inheritance tax. And so we have some inheritance tax changes that have occurred. Is that correct?
Yeah, that's right. So under the current system, we have a similar thing for non-doms, where if they're non-dom for the first 15 years of residence, they only are subject to inheritance tax on their UK assets. Okay. Whereas if you're UK domiciled or you've been here more than 15 years, you pay inheritance tax on your worldwide assets. And our inheritance tax is not dissimilar to the US estate tax on death. It's about 40%. But the key differences are we don't have a tax on lifetime giving. If you're giving to an individual, it's only if you die within 7 years of the gift that gift is sort of included when you're calculating your inheritance tax on death. And one of the major differences is our allowance is very, very small. So we call it a nil rate band, and it's only £325,000 per person. And it's been at that level since 2009. So
Oh my
obviously,
goodness.
if it was the right level in 2009, it's pretty low now given inflation.
Yeah, no, wow, that's crazy. We're hovering close to $14 million exemption in the United States, so a vast difference there.
Yeah, quite a big difference. And so even with sort of reliefs, individuals, say US individuals who are in the UK and may therefore be subject to UK inheritance tax, that difference between 325 or 650,000 for a couple and the US exemption means even though the rates are similar, you could be paying a lot of tax in the UK when you're not paying anything in the US. So, you know, ignoring the fact that you might be able to get relief in one country or the other, it's not going to help you if the band's just much lower.
Oh my goodness. Okay. So what's going on with the changes then? Where are we at now? What are we looking towards?
So once again, they're going to ignore domicile going forwards for these purposes and look just at residence of people. Okay. So currently we have a test where if you're non-dom but you've been resident for 15 out of the previous 20 tax years, you're subject to inheritance tax on a worldwide basis. We're, as I say, ignoring domicile and just looking at everyone. If you've been resident for 10 out of the previous 20 years, that's when you're going to be subject to inheritance tax on a worldwide basis. So for new arrivals, that means after 10 years, worldwide basis for inheritance tax. And if you want to avoid it, the key is you've got to leave by the end of your 9th tax year so that you never have that 10th year. They've also introduced a tail. So if you have been resident here for more than 10 or more years and you leave the UK, your worldwide assets stay within the scope of inheritance tax. Now, that tail is at least 3 tax years. If you've been resident for between 10 and 13 years, and then for each additional year of residence, you have an additional year of your tail. So individuals who are resident for 17 years have a 7-year tail, 18 years, they have an 8-year tail, and then the maximum tail is 10 years.
And when you say years, you're talking about UK fiscal years.
Yeah, exactly. So once you've been non-resident for a full tax year, that's your first year of your tail. And so it's 10 UK tax years until you lose that worldwide IHT exposure.
So I need to get stuffed into like a hyperbaric chamber for 10 years, frozen in time for 10 years, like Han Solo and Star Wars, right? And then revive me, and then, you know, I'm past the tail issue.
Exactly. And I think what we will actually see, so one thing we have said in the UK is the real winners from this rule are the UK persons who have gone abroad. Maybe they've retired in the south of Spain, but they still are UK domiciled, they're still connected to the UK. Once you've been non-resident for 10 years, even if you spent 70 years of your life in the UK, 10 years of non-residence, and you're outside the scope of UK inheritance tax, and you're done. So those are the real winners of this. Whereas obviously the losers were those who have been here for 10 years and currently aren't subject to worldwide tax on their assets.
Yeah, it's kind of a gotcha thing. So is there something that I need to file with HMRC to notify them one way or another? Like if my 10 years is up, do I need to like, hey, my 10 years is up and I'm outside of the deal here, or?
No, there's not. So there's only our inheritance tax system is what we call self-assessment. You know, the executors file with HMRC and say, look, here's all the tax on the assets. Now, if you've got UK assets, you have to file an inheritance tax return to get probate. So those people who still have houses in the UK or other assets here, they would be filing those returns anyway. So that would be HMRC's chance to say, hang on a second, that guy was resident here just 5 years ago. Can we have details of the worldwide assets, please? But actually, you know, if you left the UK, let's say 9 years ago, and you have no UK assets, you're going to have some very honest people to go to HMRC and say, here you go, here's a return reporting all of my worldwide assets, and here's 40% of the value. So it's it's an interesting law in that it's going to be quite hard for them to enforce. It's going to be, I think there will be a lot of accidental non-compliance, and also I think there will be some intentional non-compliance on this.
And does the UK tend to do a lot of audits on this kind of stuff? I mean, because in the US, gosh, I've been doing this for 20 years. I can't recall the last time I've even seen someone get audited for a gift or estate tax issue. It's just something just not very common from at least from what I see. I don't know, maybe other people see it a whole lot more than I do, but I think the IRS spends their resources mostly on the income tax part of it, not on the estate tax. So is this do they tend to have a squad that deals with this at HMRC, or is it highly prevalent?
Yeah, I mean, I would say we regularly see audits.
Okay.
I personally don't see very in-depth, nasty audits very often. They tend to be asking very sensible, reasonable questions, and then move on. So at the moment, the inheritance tax return, if you're only filing UK assets because you're saying I'm not UK domiciled, there's a form you fill in that gives various answers around your domicile to explain why you only have to report the UK assets. So I would be expecting there to be something on that form that says, when were you previously resident? Give us details. Where were you tax resident for the last 20 tax years? And then they'll be able to challenge that. They'll be able to compare it to maybe income tax returns they've received that you filed previously. And they might be able to say, for example, information under the common reporting standard that they hold might give an indication of residence. So I think we will see people being audited, but actually it should be fairly clear cut. If it's very clear, I was resident up to this point, I've only been gone for 5 years, HMRC will know, and so they'll know you're supposed to be reporting worldwide assets.
Gotcha. And for the audience, you mentioned common reporting standard. Can you just quickly tell us what that is? Because we don't have that in the US.
Yeah, so the common reporting standard is basically what everyone other than the US has instead of FATCA. So it's where information on financial assets gets reported by, say, a bank to the, let's say it's a Swiss bank. They will report that information to the Swiss tax authorities, who will then exchange it with the UK tax authorities if you're a UK resident. So similarly, if you had a UK bank account and the UK government would be giving information and told, can you send this to the French authorities where this individual is resident, they'll know that individual is resident in France.
Gotcha. Yeah. So CRS is kind of like a global version of FATCA. There's a podcast that did that not too long ago. I'll make sure to link it in the show notes so that everyone can, if they want to go back and educate themselves on the Foreign Account Tax Compliance Act in the U.S. And it has not worked well. I'll tell you that right now. It's not, they spent a lot of money on it for not a lot of return. So I have no idea how CRS is doing in your neck of the woods. Hopefully it's doing a lot more. I guess maybe not, depending on how you view it. But for the U.S. purposes, it's not gone all that well.
Yeah, well, it was introduced following the FATCA model, so right. I think basically HMRC have gotten a lot of information that they don't know what to do with, is the answer.
Same with the IRS. They're not really sure. Okay, we got all this stuff now. What? Okay, getting back to the topic at hand, the inheritance tax. So, is there something that folks should be thinking about or doing like right now? Like if I have a client that's thinking about going into the UK, 2 scenarios for you. Client thinking about going into the UK, kind of going into this new regime. They haven't previously been in the UK. Is there something they should be thinking about? And then a client that's already in the UK, maybe they're stuck under these rules. Is there anything that they should be thinking about or doing?
Yeah, so I think, the first point is count those years, work out when it is you're going to be subject to inheritance tax on a worldwide basis. For that new arriver, they're going to have 9 years before they need to worry about this. Maybe they're only planning to move to the UK for 5 years. It shouldn't affect them. For the person who's already here and will be affected, work out exactly the date. Maybe it is 5th of April, maybe it's a later date. And remember, this is 10 years. So the FIG regime is only 4 years. So some individuals will be subject to worldwide taxation on income and gains, but not on inheritance tax to begin with. So check that date, number one. And then I think If you are going to be here, there's a few options. So one, as I said, lifetime giving is very popular in the UK because we currently don't tax lifetime gifts unless you die within 7 years. So for those people who are younger, who might be thinking of gifting assets to their children anyway, you might want to consider those maybe slightly sooner than you would have done. Another thing which I think is going to be really popular is insurance. So at the moment, a lot of people say they make significant gifts to their children and then they insure themselves for 7 years. If something happens to me in that 7 years, the insurance pays out and that covers the inheritance tax bill.
Oh, that's beautiful. That's an interesting take. Okay.
Yeah, and because it's for just a term, it's 7 years. It's a lot cheaper essentially than if you got whole of life cover. So insurance is quite popular at the moment. I think it's going to become more popular because someone will say, look, I'm going to be here for another 3 years. I'm then going to have a tail period of say 5 years. So I've got 8 years where I'm going to have an exposure to UK inheritance tax. They could get insurance to cover them for 8 years. As if they're young, fit and healthy, that insurance isn't going to be expensive. So that's really something I think people should consider, particularly if they know what that period is going to be. They know when they're going to be here until they know what their tail will be. They can insure for it.
And for gifts, is there a step up in basis to the giftee, not the giftor to the giftee? Does the giftee then get, so let's just say I own a house, I bought it for £100,000 and now it's worth £500,000 and I gift it to my daughter. Does she take it at £500,000 as her cost basis, or does she take my cost basis?
So she would get a new cost basis, but you would have capital gains tax to pay.
Oh.
So that's the downside of lifetime giving, is it's a disposal. Now, if you're talking about say business assets, an interest in your private trading company or something like that, this works for farmlands, for example, you can gift a business and they will receive it at your original base cost. So you make a claim, you say, look, I'm not paying capital gains tax, it's a business asset, so I'll pass it to my daughter, but when she sells it, she had my original base cost. So for certain assets you can do that, but yeah, that is the downside of lifetime giving, potentially capital gains tax.
Yeah, so it sounds like to coordinate with on the U.S. side, you got to be real careful on, because the gifting, I mean, again, we have the $14 million unified credit, whether it's gift or estate. So for the gift tax purposes, probably not that big of an issue, but the basis is something that I think needs to be looked at very closely. And then as far as the inheritance tax stuff, the sense I kind of get, like you said, is work out your dates, work out your timeline. Sounds like there's a lot of pre-work that you just need to set into place with certain like markers and dates, and that all needs to be kind of ironed out and just have a good plan, a solid plan in place. Is there anything else we need to consider about the inheritance tax before we go on to our next topic?
Well, I think a key thing is look at lifetime giving before you're within the worldwide scope. So if you're coming up to the end of your 9th year or the end of your 10th year, you're going to stay in the UK, make that gift whilst you're still outside the scope. Say, if you've got 14 million exemption in the US, gift 10 million during your lifetime, no tax in the US, and it's outside the scope for UK purposes.
Oh, very cool. Love that. Okay. And I love the insurance angle too. I think that's another area that I think is, like, I agree with you. I think that's not just in the UK, but I think also in the US, we're seeing people kind of insuring their tax liability. Maybe there's gray area positions that they can't get an opinion on, or that people are not too sure about, or there's a state tax liability, in certain areas and issues. Folks don't want to mess around with blocker companies or blocker trusts. They're just like, look, I'm going to calculate the estate tax for the federal, and maybe there's a state tax, and I'm just going to buy an insurance policy for a term or a certain period of time to cover. Like you said, term is much cheaper than whole, so you can certainly mitigate, those issues. Okay, the last big topic that we're going to get into today, which is the trickiest, I think, of all the big three that we've kind of identified here. It's always tricky for me because people will come to me and say, Mish, I've got these revocable trusts and I'm going to go to live in London. And I'm like, no, wait, slow down, wait a minute. Talk to me about what's going on with foreign trusts? How does the UK look at that? What's changing there? Let's get into that topic. That's the final third big topic we're talking about today.
Yes, as you say, headline is it's complicated. We have a lot of anti-avoidance rules around non-UK trusts. So we have trusts that are very well established in the UK. There are rules around taxing UK resident trusts. They pay full taxation. But then we have all these complicated anti-avoidance rules for non-UK resident trusts. So one thing that's always really important to note, that a trust is UK resident if all of its trustees are UK resident, or some of the trustees are UK resident, and it was set up by someone who was UK resident. So we see this a lot with US trusts, where perhaps an individual has a grantor trust and they're also the trustee of that trust. By moving to the UK, they also bring their trust to the UK.
Yeah.
So number one is always check before you move here, because by the time you've moved here, it's too late. So always make sure you know what the position is before you move here.
Gotcha.
Because what you think of as a US trust, we might then consider a UK trust. And then we get into another world of complications. So that's best avoided. Keep it in the US probably is the answer. Maybe appoint your sibling who's staying in the US as trustee.
And there's nothing under the treaty that helps me out with that, right? There's no provision that I can go to get relief under the treaty. You're just kind of stuck at that point in time.
Yeah, because the treaty looks at residence. So you've become UK resident. So it's the answer is it's complicated. Don't put yourself in that position.
Okay, so tell me what's changing, what's going on there, what do we need to know?
Yeah, so we have a series of sort of anti-avoidance rules that look through trust structures and corporate structures and tax the income and gains on them on the sort of either the UK settler or in some cases the beneficiaries. So at the moment, there's some quite favourable rules where these trusts have been set up by non-doms that broadly say, look, if you set this up when you were non-dom before that 15-year period where you became taxable on a worldwide basis, and you don't add any value after that 15-year period, we're not going to tax you on the income and gains of the trust. We're going to let it roll up in the trust tax-free, and we'll only tax you if you actually take something out, if you actually get a distribution or a benefit. So those are great. That's really helped us out, particularly with US trusts where we have to worry about the US tax as well. That's really helped us out in the past and has made it much simpler. Look, you pay tax on what you take, if not, no tax. They are removing those rules that offer those protections. They are going to say, look, if you're a UK resident settler of a trust, we're going to tax you to income tax, capital gains tax on all the income and gains of those trusts. Obviously, where you have a trust in, say, like a tax-free jurisdiction, the Channel Islands, Cayman Islands, something like that, there's no other tax to worry about. So you're just going to pay tax like you would if you had those assets in your own name. Now, where you've got a US trust, or we see it as same in Australia, New Zealand, where they tax their trusts, it gets complicated. Hopefully, we can get tax credits under treaties. But because of the differences in rules in different jurisdictions, it might not be possible in all cases. And especially with things like US LLCs are treated as opaque in the UK, transparent in the US, it can get a little bit messy, let's say. So certainly everyone should be reviewing their trust structures to establish how they would be taxed, but particularly if you are going to want to be getting tax credits for the tax paid in another jurisdiction, that's going to be really, really important.
Yeah, that's super interesting, because we take the example of a revocable trust. A revocable trust is not a taxable entity. There's actually nothing until you either are deceased or incapacitated. And so it's look through, just kind of like what you're talking about, meaning I'm paying all the tax on the income anyway. I guess my question is the tax a trust tax, and that then makes it not creditable against the individual income tax? Like, how does, I guess that, I have the same questions that you have about the credibility of taxes against the two regimes. There might be some issues there.
Yeah, so it's an individual tax, which means
Okay.
that in some cases we should be able to get tax credits. So,
Okay.
it's if in the US it's look through, in the UK it's look through, it's the same income being taxed. We should be able to get tax credits, hopefully. So there might be situations where it's fine. You're already paying full tax in the US. Now it's just a case of, okay, I'm going to pay some in the UK, some in the US, make sure I claim the credits, but the position will be broadly the same. It's just a case of making sure, okay, let me make sure I'm not paying too much in the US so that by the time I paid it in the UK, I've paid 85% tax, and I've got 2 months until I can get a tax-free payment in the US or something like that. We obviously don't want that situation. We do want to pay, hopefully, tax once and claim the credit in the right place. So in some cases it will be okay. In other cases, as I say, it's that difference in tax treatment between the two jurisdictions that'll cause the potential issues. The LLCs being a key one, but lots of different ways in which things can be taxed, and things that are tax-free in the US might not be tax-free in the UK. Reliefs that might be available in the US, for example, certain types of charitable giving might not be available in the UK. So there's quite a few things that could actually change what your final tax bill is.
Right. So I think you're referring to the charitable trusts we have here in the U.S. And it's a super interesting to think about now, because in my head I'm like, well, if it's a separate entity, legal entity in the U.S. that's opaque, and the entity itself is the taxpayer, then it sounds like you got a double tax problem. However, if it's a pass through and it's transparent, even if it's an LLC or if it's a revocable trust, it sounds like, and in my head, I'm like, I got to write a white paper on this now. I got to get this kind of squared away and make sure everyone understands that, because that didn't used to always be the case. So sounds like some of the more basic planning and structures, the simpler structures, are going to be okay. It sounds like, I won't say definitively. And it sounds like there needs to be a lot of consideration for more advanced structures that maybe don't coincide with these new rules.
Yeah, absolutely. And one thing that's going to be really important to look at actually is we have, for some of these rules, particularly where we're talking at company level, we have what we call motive defences. So because these are anti-avoidance rules, they also have these let outs where you set up a structure, but you don't have a UK tax avoidance motive for setting it up. So the sort of most clear-cut example of this are trading companies established in the jurisdictions where they're trading. No one says that, look, you set up a French company to run a French factory, which is employing French workers and producing, whatever it is, TVs in France. No one's going to say, look, you set up that French company for UK tax avoidance. It's clearly a French trading company.
Right.
We would say, look, you've got motive defense. We're not going to tax you on the profits of that French company. Whereas the opposite side is, I'm a UK resident, I've set up a Swiss company with a Swiss bank account to hold all my investments. That's going to be looked through. I'm going to pay tax on all the income and gains arising on those investments. So where we do have, particularly where an individual's got a structure they've established for a long time, that's common in the US, that is, you would expect to sort of people to set that up for US reasons, nothing to do with UK tax. We might be able to benefit from some of these motive defences. As I say, that particularly at company level, at trust level, it's unlikely that you wouldn't be fully taxed in the UK, but that would help. If we've got LLCs, for example, that we treat as opaque, but you treat as look through, that might solve the problem, because the UK just won't seek to tax it.
I see. Yeah, what you're talking about sounds a lot like how the IRS looks at our controlled foreign corporate regime. We don't have motive defenses. The big question is, why would you need to have, if you're a U.S. person, why do you have a foreign company? Why don't you just open up a U.S. LLC to do the work? And then, if you do have it and it's operating in that country for a specific reason and it's doing a sailor service, then we have some relief under our tax code. But I like the motive defenses. I like that. To me, that's a much more straightforward answer. And maybe we should adopt that in the US. Okay.
I can confirm they're not straightforward.
Oh, they're not straightforward. Okay. So you still have to kind of fight with them a little bit. Got it. Okay. Anything else on the trusts that the listeners need to think about or know, other than just it's complex and you really need to get with someone and plan it out and think through it, and make sure you don't run into it double tax issue. Any other tidbits or items that you want to talk about?
Yeah, so just referring back to that 4-year FIG regime, that also applies to the trust income and gains. So again, it means you should get relief from it, but also you're going to need to report it. So it's, drawing those two rules together, having a look at how it applies and what do you need to put on your tax return. Again, it means particularly if you've got one of these structures, more and more important to get the advice before you move to the UK.
And so your tax return in the UK is going to look substantially different come next year reporting, right? So we're not going to get something to look at soon. It'll probably be in 2026 that we'll see a brand new UK tax return.
Yeah, exactly. So it's going to be, so firstly, these individuals this year, they might be just ticking a box saying remittance basis, please. From April 25, that tax return, as you say, will it look different? It will have to be, but also the volume of things they're going to need to put on their tax return could increase hugely. And yeah, the report, as you say, hopefully the AI is coming to help us do some of this reporting because it's going to get
the AI will be the key. Okay. Awesome. And I would opine that you kind of follow along the US and create schedule FIG. I think that would be make it really US centric right there. Because I'm super excited to see the new UK tax return whenever this comes out. And maybe we'll have you come back and kind of whiteboard for us kind of how it all breaks down and how to think about it. Because I think it's going to be all the reporting you're talking about. I mean, if you have someone that's got several trusts and several companies and all sorts of offshore assets in a bunch of places, and the reporting is going to be, I think, quite substantial. And I guess my advice to any of my clients is don't try to do it yourself, especially at the beginning. You really got to get someone that knows what they're doing and can kind of lay it out properly. Because if, like you said, if you don't do it correctly, you don't get the relief, and then you could be in big trouble.
Yeah, absolutely. I think historically, it's been much, much easier for people to do their own UK tax returns. A lot of people file their own returns in the UK. They are much simpler. But, we've always said for people with overseas assets, etc., it's more complicated. It's going to get so much more complicated. Really take professional advice is going to be really important. And HMRC will expect you to do that. So they won't be forgiving because you make all these errors because you decided to do it yourself. They'll have expected you to get professional help.
Yeah, of course. Okay. Speaking of that, and I refer so many of my clients to Saffery. I depend upon you guys. You guys do great quality work. You have for a very, very long time. I trust your firm implicitly. Saffery's been around for how long now? How long has the firm been around for? 70 years, 80 years?
Much longer than that. Since
longer than that,
1800s, yeah.
Yeah, wow. Okay. So your firm's been around forever. It's part of the Nexia International Network, which I think we're the 8th largest accounting network now. So the Wolf Group, we're also a part of the network. We were joking. I was joking with Claire because at the dinner in Singapore, we were sitting next to the firm that won Firm of the Year, Nexia Firm of the Year. And we were joking because the Wolf Group is the 2012 Nexia Firm of the Year. You had the 2-time winner of Nexia Firm of the Year from Georgia. I was like, when's the last time Saffery won Firm of the Year? Which is never, but you guys really should win Firm of the Year at some point because you guys are fantastic. But tell our audience about, how can they get in touch with you? I'm assuming you've got a massive, as they say in the UK, queue of people that want to come that will need advice. How do you guys work? How can they get in touch with you? What services do you offer? Give us the scoop.
So, in terms of the services we offer, we're a, full service accounting firm. So we can do accounts, audit, tax advice, tax returns, whether that's your personal returns, your corporate, your payroll for your employees, VAT, that's our value added tax, sales tax. We can do the lot. But I think, where sort of I suspect your listeners might be interested or would be wanting to contact me will be, I'm moving to the UK or I'm living in the UK, help, what do I do ahead of April? And if that's the case, please drop me an email. It's alexandra.Britton-Davis@saffery.com. You can find me on the website. And the first step is always an initial phone call or an initial meeting let's chat about your situation, work out what we can do for you, and then we'll send you a sort of a scope of work, fee estimate, and we'll proceed from there. But yeah, the key is have that initial chat, work out, what is the issue? Do you have an issue? Maybe you're worried about something you don't need to be, but let's have a chat, work out what we can do for you, and go from there.
And you guys have KYC rules, right? They have to supply, to work with you, they have to supply a copy of their passport and some other stuff, right?
Yeah, so we're subject to sort of standard anti-money laundering procedures. So yeah, proof of identity, proof of address, details about source of wealth, etc. I think for a lot of people, very standard now. But yeah, particularly for international clients, they're used to providing it to their banks, their lawyers, but it's
pretty much everywhere but the US. But I think we're close to being on the same page there. Okay, that's fantastic. Alex, thank you so much for coming on today. I learned a lot. I always learn a lot every time I talk to you. Alex gave a fantastic presentation in Scotland. And it was kind of got me thinking, even before this podcast launched, I was like, I got to get Alex on the podcast. So I'm so glad that we got you on here. Will you come back maybe after you go through your craziness of next year? Will you come back and maybe give us an update on how it's going sometime next year?
Yeah, absolutely. Would love to.
All right. Fantastic. Thank you so much.
No problem. Speak soon.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.